Welcome to Tech Journey Studios. Today we're diving into how to start investing in the Indian stock market as a beginner. Let's get started first, the basics. The stock market is where shares of publicly listed companies are bought and sold. In India, we have two main exchanges, the BSE, or Bombay Stock Exchange, and the NSE, or National Stock Exchange. BSE's benchmark index is Sensex, tracking the top 30 companies, and NSE's is Nifty 50, tracking the top 50. These indices help investors gauge the overall performance of the market. Why invest in stocks? Investing in the stock market can yield high returns over the long term, often outpacing other assets like fixed deposits, gold, and real estate. With India's growing economy, a young population, and booming sectors like technology and renewable energy, investing here can be especially rewarding. Step 1. You'll need a demat account to hold shares electronically and a trading account to buy and sell stocks. You can open these accounts through brokers like Zerodha, Upstocks, or major banks. Look for low fees and a user-friendly platform. Now let's go over the key metrics to evaluate a stock. Earnings per share, or EPS. This shows how much profit a company makes per share. Higher EPS often signals better profitability. For instance, Infosys has a higher EPS than some of its peers, indicating strong earnings price to earnings, or P/E ratio. This tells us if a stock is overvalued or undervalued if Reliance Industries has a ratio of 25. Investors are paying 25 times the earnings per share. Compare P/E ratios within the same industry for a better picture. 3 price to book, or P/B ratio. This compares a stock's price with its book value, A/P. B ratio below 1 can indicate an undervalued stock, but check within the same industry. For example, State Bank of India might have a lower PB ratio compared to HDFC Bank 4, debt to equity ratio. This shows a company's debt compared to its equity. Companies with lower debt are generally more stable, especially in tough times. Tata Motors, for example, has a higher debt-to-equity ratio due to its capital-intensive nature. Dividend yield. This is the dividend paid relative to the stock price. Stocks like ITC or Hindustan Unilever often pay dividends, providing steady income in addition to price appreciation. 6. Return on equity, or ROE. ROE measures how well a company uses its shareholders' money. A higher ROE often points to efficient management. For instance, HDFC Bank has maintained a high ROE, indicating good profitability. It's also key to understand sector trends. Certain sectors in India have strong growth potential. For example, technology companies like TCS and Infosys benefit from India's digital expansion. Pharmaceuticals like Sun Pharma are gaining due to increased healthcare demand. Renewable energy companies like Tata Power are positioned well as India pushes toward cleaner energy. Remember the importance of diversification. Spread your investments across different sectors. Don't put everything into one. This way, if one sector underperforms, the others can balance it out. It's also essential to stay informed and manage emotions. The Indian market is influenced by global trends, policies, and economic factors. For example, global interest rate changes or inflation can cause market volatility. In such times, avoid making impulsive decisions. Stick to your long-term plan. Economic factors also impact stock performance in India. For instance, lower interest rates often benefit banking and real estate sectors. Inflation can impact consumer goods due to rising costs. Economic factors, stock performance, India. Lower interest rates, banking, real estate sectors. Inflation, consumer goods, rising costs. Government policies like Make in India have boosted manufacturing companies. To recap, start by opening a demat and trading account. Analyze key metrics like EPS, PE, and debt to equity through diversify across sectors to manage risk. Keep an eye on trends in the Indian economy. B. Be patient and avoid impulsive decisions. Thank you for watching. If you found this guide helpful, please give it a thumbs up, share it with someone starting out, and don't forget to subscribe to Tech Journey Studios for more investing insights. See you in the next video.